Once the position is opened, it must be properly managed in order to extract maximum profit from the price movement. According to professionals, position exit technique is one of the most important conditions for determining the profitability of entire strategy. So let's talk about the rules of position and capital management. As for the triple screen strategy, here, the author offers two different options for position management. The first option is a conservative. Regardless of which option is used for position management, according to the rules of the strategy, after opening of a position, trader must set up a protective stop-loss order. Prices should move away from the entry point more than 1 ATR, or 1 average daily price range, before the trader would be able to move his protective stop to the break-even level. If prices continue to move in a favorable direction, trader should take all necessary measures to protect his floating paper profit. When using a conservative approach, trader should apply 2% rule to his paper profits. In other words, the trailing stop of a position should follow the price in the direction of the game, so that no more than 2% of the growing assets of trader would be at risk. Conservative traders must start their trade after the strategy generates the very first buy or sell signal, and stay in the game as long as the underlying trend is not changed or a safety stop does not withdraw them from the game. Dr. Elder also recommends taking profits when EMA on the weekly chart begins to move horizontally. Here is how the conservative approach works in action. If trader uses an aggressive approach, then he should apply the 50% rule to his paper profits. In other words, in such situation, it is necessary to determine the highest high reached by the market during uptrend, or the lowest low reached by the market during downtrend. After that, trader should set a trailing stop between the price extreme and his point of entry into position. For example, if price moved a distance of 2 ATR from the opening point, then trader should set his trailing stop, so as to protect 1 ATR of his paper profit. In addition, active traders can use each new signal from daily oscillator to gradually increase the size of their open position. They should take profits according to the signals of the second screen. For example, if a trader is bullish, and the force index becomes positive, or stochastic oscillator rises above 70%, then, he can sell to make a profit and keep an eye for the next opportunity to buy. Here is how the aggressive approach works in action. In his first book, Dr. Elder did not say too much about capital management. The main recommendations are related to the limit of risk in the transaction. According to Alexander Elder, protective stop-loss orders should be set in such a way that in case of unfavorable price movement, losses would not exceed 2% of the trader's capital. Dr. Elder recommends avoiding transactions where the logical level of protective stop order could result in a loss amount more than 2% of assets. This limit of losses includes commissions and spread. He also notes that if weekly MACD readings coincide with the indications of weekly EMA, that may indicate a very strong trend, and allows trader to open a larger position. Among other things, Alexander Elder also recommends using the second screen of the strategy in order to determine the reference points of take-profit and protective stop-loss orders, as well as to compare the potential risk to reward and make a decision as to whether it is worth opening the trade or not.